Today's Technically Speaking post is talking about interest rates and what's technically going on with yields. And what I did was I wanted to understand a little bit more. There's been a lot of call here lately by Jamie Dimon over at JP Morgan saying interest rates should be 4%. They should be going to 5%. The problem is that in the U.S. economy, people buy payments. They don't buy stuff. You don't go buy a house and say, well, you know, I always love it, right? If you ever hired a realtor to go buy a house, they go, what? How much of a house? Danny, how much of a house do you want to buy? I want to buy a $250,000 house. Great, I have some great selections for you. So they throw you in the car and they take you, and the first house they show you is like $400,000. Of course, you walk in, it's like, wow, this house is great. It's got the crown molding, it's got everything I want. And you go, well, how much is it? It's like, well, it's $400,000, and but if we work the magic with your budget, we can get your payments to where it's basically the same thing. And of course, when you go look at the $250,000 house after that house, it looks like complete crap. So you wind up buying the $400,000 house and stretching your budget. But it all comes down to the payment. Can I afford the payment? Same thing with cars. We're buying cars today and we're having to stretch payments out for 8 years in order to get the payment low enough to afford. So when interest rates go up, and if you do talk about interest rates on the 10-year Treasury going to 4 or 5%, things in the economy will absolutely become unaffordable. More importantly, the cost of capital expenditures by corporations. We already have an inverted yield curve on the corporate yield bond index, which is basically saying the short end of the bond index and the long end have actually inverted, which suggests that the cost of building out new products, plant, equipment, doing CapEx expenditures is already moving to a non-profitable stage for companies to where they have to make the decision saying, yeah, I'm not going to do that project because my return on investment isn't warranted by the interest rate I've got to pay to do it. If interest rates rise further, that's going to become more problematic for the overall economy. These are the drivers of the economy. Consumption is what drives the economy. So we looked at yields today and Technically Speaking and found that whether you're looking on a weekly basis, a monthly basis, a quarterly basis, or an annual basis, when you start looking at where yields are currently, every time in history, going back to 1940, 1950, this has denoted the peak of an economic cycle, not the beginning of a new one. So higher yields from here, while people keep talking about it, yields remain below 3% on the 10-year Treasury. And every time we get above 3%, well, things happen to the stock market like earlier this year. So pay attention here to what's going on with yields. We have a record number of short bets against the U.S. Treasury. Now that means there's a whole bunch of bond traders out there betting that rates are going to go higher and bond prices are going to go lower. So they're short bonds right now. They're selling bonds they don't own. And one of the contrarian natures of the market is that when everybody's on one side of the boat, something else generally happens. And this is one of those bets right now where everybody literally is on the same side of the boat. There's been rare cases in history where it hasn't turned out where the market didn't do something exactly the opposite. So one of the things to watch here very closely is what's happening with yields. I think the yields on bonds are telling us there's a problem brewing within the markets over the next 6, 8, 12 months. And I want you to really pay attention to it because I think the risk to investors is definitely elevated. Now, let's bring this back to short term. That article is on the website today. Technically Speaking, what are yields telling us? That's on the website now, along with our installment number 10 on our buy and hold myths. We're getting ready to wrap up that whole series over the next couple of weeks. Next week is going to be investment strategies and how to manage your money better. So get in tune with that series. We've been really debunking a lot of the myths of long-term investing over the last 10 weeks, and we're going to wrap that series up, and that's soon going to be a book coming to you. So keep watching that as well at the website. Let's talk about the markets here from a short-term perspective because the markets have been rising as we've talked about over the last several weeks. Really, I've been mapping out these pathways in our weekly newsletter talking about the markets moving back towards all-time highs. And every time we broke through one of these resistance levels, we have added exposure to portfolios. That's continued to work well here. We're extremely overbought here in the short term. And as we talked about yesterday, there's been very few points in history where we've been this overbought in terms of the market and we didn't have a correction in prices at some point. Now, it doesn't mean a crash. It doesn't mean like a major drawdown. It simply means that there's very likely going to be a relaxation in prices. Somewhere back to around 2,800 would be most likely on the S&P, and that would actually set the market up for another rally potentially to new highs. One of the things I kind of expect here is that we may try to rally up towards new highs this week. I said that in the newsletter on Saturday, that look this week for the market to retest old highs. We're in the process of doing that. We haven't quite done it yet. We're still below the all-time highs going back to January of this year. But look for an attempt to break through that. We may actually get just a little bit above it. Then we get a retest and a pullback here, maybe to around 2,800, 2,850, and that will likely provide us a decent opportunity to add a little bit of exposure here moving in towards the last half of the year, as particularly we get ready to wrap up this year. Importantly, though, I do think that we're getting much closer to the end of this cycle, and this whole corrective process we went through over the last couple of months, we've seen this previously back in 2007, this type of action that led to new highs, but was ultimately the setup for a much deeper correction over the course of the next 12 months. And I think that's still possibly one of the setups we have here. Lots of valuation metrics also suggest the same thing. And our article on Thursday is going to be talking about marrying technical analysis with fundamental analysis to get better signals on managing your portfolio. So keep a watch on that for real investment advice as well.